The Port of Los Angeles, which is the busiest in the U.S., is seeing significantly less cargo and containers this month.
May overall has been a pretty light month, bookended by very low first week in volume, down more than 30%.
The tariff slowdown has begun. Bookings of container shipments from China to the U.S. are down nearly 50% compared to a year ago.
Over 10,000 shipping containers are currently stuck at major U.S. ports from Los Angeles to New Jersey as logistical bottlenecks deepen. Truck drivers are going unpaid, deliveries are being canceled, and pressure is mounting on the already strained U.S. supply chain. At the same time, the U.S. economy contracted by 0.3% in the first quarter of 2025, according to preliminary government data, a clear signal that this is more than just a seasonal slowdown. Retailers are bracing for new rounds of inventory shortages, and shelves in some regions are already thinning out. What we're seeing may look like a backlog, but the pattern suggests something bigger, a quiet unraveling of core economic functions, one container, one canceled shipment at a time. To understand how 10,000 containers ended up stranded at U.S. ports in 2025, we have to rewind not just a few weeks, but all the way back to the aftermath of COVID-19. The global pandemic exposed vulnerabilities in supply chains from production in Asia to last-mile delivery in the U.S. While demand for goods surged during the recovery years, the infrastructure to move those goods ports, trucking networks, railways, and warehouses never fully stabilized. What followed was not a singular crisis, but a slow-burning, multi-year unraveling of coordination and capacity. Between 2022 and 2025, businesses faced persistent disruptions, port backlogs, driver shortages, container misallocations, and volatile fuel costs. These were compounded by unpredictable trade policies swinging between isolationist tariffs and reactive international agreements that left shippers and carriers with no clear long-term roadmap. The U.S. federal push for America First manufacturing also had unintended consequences. While it aimed to reshore production and reduce reliance on foreign suppliers, it didn't come with the logistics investment needed to handle that volume domestically. As a result, instead of creating resilience, we created choke points, overloaded ports, congested highways, and aging freight rail systems unable to keep up with redirected trade flows. Meanwhile, the private sector leaned heavily into just-in-time logistics, pushing supply chains to maximize efficiency but minimize flexibility. That model works well until it doesn't. By 2025, with fuel costs elevated, warehouse space limited, and truckers either underpaid or walking away, the entire system began to wobble. The result: today's crisis wasn't born overnight. It's the product of years of political whiplash, structural underinvestment, and economic pressure building slowly in the background. The U.S. logistics system, once considered a backbone of global commerce, now operates like a system held together by band-aids. And when the pressure spikes, it doesn't bend anymore. It breaks. As of mid-2025, the U.S. supply chain is experiencing a widespread and deepening paralysis. Across key ports, including Long Beach, Los Angeles, and New Jersey, container ships are stuck in holding patterns, waiting days or even weeks to unload. Thousands of containers remain untouched, sitting idle on docks or stacked in overflowing yards as port operators scramble to keep up with reduced staffing and limited truck capacity. Behind the scenes, truck drivers, the human backbone of last-mile logistics, are staging a quiet but powerful form of protest. While not formally organized as a strike, many drivers are refusing to take loads due to unpaid invoices, slashed rates, or untenable delays at terminals. Some report waiting up to 10 hours for a single container, often without compensation. Others are simply walking away from the industry altogether, saying the math no longer works. Their absence is compounding the port crisis, turning congestion into outright gridlock. The impact doesn't stop at the docks. Across the country, manufacturers are reporting inventory shortages, especially in critical components such as electronics, auto parts, and building materials. Retailers are also feeling the pinch not just on big-ticket imports, but on basic consumer goods. From supermarkets to hardware chains, stock levels are dropping, and in many cases, companies are choosing to slash or delay Q3 2025 purchase orders rather than pay premium prices for delayed shipments. What's most alarming is that this isn't a single-point failure. It's a systemic unraveling that spans from port to warehouse to store shelf. And while the public sees only the empty spots at retail, what they're not seeing is the invisible machinery behind the scenes, one that's now out of sync, understaffed, and running at half speed at best. This is what it looks like when a logistics system not only slows down but loses its ability to catch up. And unless structural action is taken soon, today's delays could become tomorrow's shortages, pushing the American economy closer to a full-scale distribution crisis. The fallout from America's port paralysis is not being shared equally. As the system buckles, it's becoming painfully clear who is absorbing the damage and who, at least for now, is escaping it. Consumers are on the front lines facing rising prices and shrinking choices. With fewer goods making it to shelves on time, shortages are becoming more common, and not just in niche markets. Everyday products from household essentials to electronics are disappearing from inventories or being sold at a premium. For many families already stretched by inflation, this disruption is yet another blow. Confidence in the economy is eroding not because of abstract numbers, but because people can no longer trust that the goods they need will be available or affordable when they need them. Small and mid-sized businesses are faring even worse. Without the leverage to reroute supply chains or absorb higher costs, many are left stranded, waiting for shipments that don't come, or paying triple for inventory just to stay operational. Manufacturers and retailers alike are cutting hours, freezing hiring, or in some cases shutting down altogether. For some, the math is simple and brutal: no stock, no sales, and no path forward. Insolvency risk has risen sharply in the logistics-dependent segments of the economy, particularly in retail food distribution and light manufacturing. But not everyone is suffering. Large corporations and shareholders in big retail have found ways to adapt or at least buffer themselves. Some global brands have rerouted their imports through Canadian or Mexican ports, bypassing U.S. congestion entirely. Others have leaned on domestic warehousing strategies to minimize short-term disruptions. In the boardrooms, these moves are seen as strategic resilience. On the ground, they often look like survival privilege. Even so, cracks are forming at the top. In a signal of how serious logistics costs have become, Walmart, the world's largest retailer, has reportedly scaled back operations in multiple U.S. states, where shipping and trucking costs have made certain markets unprofitable. If Walmart is pulling out, the message is stark. This isn't just a supply chain issue anymore. It's a market access crisis. With U.S. GDP already contracting by 0.3% in Q1 2025, economists are now openly warning of a looming technical recession if the second quarter follows suit. But behind the data lies a deeper concern. The American economy isn't just slowing, it's suffocating from within. The interconnected system of production, logistics, and retail, once the engine of steady growth, is now buckling under cumulative pressure. And unlike previous downturns driven by demand or financial markets, this one is rooted in physical disruption. Goods can't move. Stores can't stock, businesses can't sell. At the heart of this crisis is a disjointed supply ecosystem. Manufacturing depends on parts that aren't arriving. Retail depends on shelves that aren't filling. Logistics depends on drivers who are quitting or stalling. It's not just a supply chain issue. It's a chain reaction where weakness in one link brings strain to the entire system. Even companies with capital and scale are being forced to delay projects, scale down inventory, and reset growth expectations. The most immediate pain, however, isn't being felt on Wall Street. It's in places far from corporate earnings calls. Truckers sit in queues for hours unpaid for their time. Warehouse workers face layoffs as volume dries up. Consumers see prices rise and availability fall, but their wages haven't kept pace. These are the people experiencing the slowdown, not as a macroeconomic headline, but as a daily reality. Fewer hours, thinner paychecks, and empty store aisles. The risk increasingly is not just recession. It's a systemic confidence collapse. If people no longer believe goods will arrive on time, businesses won't expand. If workers feel their roles are unstable, they won't spend. If families start to question whether the most advanced economy in the world can deliver groceries on a Tuesday, that perception alone becomes an economic drag. This is what it looks like when an economy doesn't crash, but runs out of oxygen slowly, sector by sector, shift by shift. For years, policymakers and business leaders have promoted the idea of reindustrializing America. The promise was clear: bring back manufacturing, shorten supply chains, and restore domestic resilience. But today, as ports sit paralyzed, trucks sit idle, and GDP contracts, the question arises, was this ever a coherent strategy? Or are we witnessing a quiet retreat masked as progress? Because if rebuilding America's supply chain truly mattered, why are warehouses closing? Why are drivers walking away? Why are basic logistics still dependent on 20th century infrastructure trying to support a 21st century economy? What we're seeing in 2025 isn't just growing pains, It looks and feels like policy contradictions playing out in real time. We talk about economic sovereignty, yet tolerate systemic breakdown. We call for independence from foreign supply, but haven't built the domestic backbone to support it. If resilience was the goal, then this moment is a sobering audit. The core of our logistics system remains vulnerable, disjointed, and unprotected. So we have to ask, is this really strategy, or is it surrender by neglect? Has America simply forgotten how to move things? Not because it can't, but because the will to invest, coordinate, and adapt has been replaced with corporate hedging and short-term politics. It's a hard question, but it's the one that matters now. So what do you think? Is this the inevitable fallout of global trade complexity, or a failure of domestic coordination and political will? Is the U.S. still capable of rebuilding a reliable, self-sustaining supply chain, or are we quietly losing a war with ourselves? We'd love to hear your thoughts in the comments, because while goods may be stuck at sea or stalled at the port, the conversation about what comes next should not be delayed. This isn't just about containers. It's about what kind of country we want to be when they finally arrive.